Hello everyone, this is the first lecture about the tax, and this lecture will focus on the basic definition of the tax and what is the history of tax in India. So topic will be covered what definition of tax, what is the direct tax and indirect tax, evolution of tax law in India and conclusion. So as far as concerned about the history of tax, the word of tax is taken from the Latin word from the taxo. So from the taxo we start the tax, and tax mean impose of charge or other levy upon the taxpayer, individual and legal entity by state or other functional equivalent states. So we can say for a state there is a requirement of revenue to functionality like the security, education and development. So for this purpose, we have collected some money or some other charges. So this is the type of tax. As far as concerned about the ancient time, tax were either material or money, like goods or the services in primitive societies. If we see the primitive society, then the society depends upon the goods and other materials, and they were not depend upon the money like in present times. We have the money in form of the currency, coins, etc. But at that time only goods and material were there. So goods and materials were collected as a tax. Pay or share income to king who provide them the administration security. As far as concerned the use of collection of tax which deposited by the individual entity or other uh, corporate sector. This is used for expenditure in war, enforcement of law, protection of the property, public work, education, health, pension, and etc. And in conclusion, we can say it is used for the development of the society. As far as concerned about the definition of taxation, it is defined by the different economists. Adam Smith defined it is considered of the modern economics defined as tax as the financial obligation imposed by the government on individual and businesses to fund public services and infrastructure that benefited society as whole. John Margaret Kane defined that tax as a means to the regulate aggregate demand in the economics. According to the Keynes, economic tax can be adjusted to the manage economic cycle and the stabilization the economic. Hayek was a economist in the Australia, and he saw the tax as a necessary evil for the financial essential public goods and services, but warned against the excessive taxation, which he believed it could be hindered the economic growth and individual liberties. So, according to the Hague definitions, tax shall be collected according to the requirement of the society. Tax shall not be collected as excessive. It will be hindered in the growth of the society. Karl Marx was a great economist and he defined that tax as a tool by the ruling class to maintain the control over the working class. He argued that the taxes were the reflection of the underlying power dynamic in society and it could use the perpetuate or challenging the existing inequalities. Laffer was a great economist and he defined the optimal tax rate beyond which higher tax rate lead to reduce the economic activities and lower tax revenue. His theory suggests that the cutting tax in some cases could lead the increased tax revenue due to the improved economic growth. As far as the Milton Friedman, he was also a great economist and he defined tax as a efficient tax system and minimal government intervention. He saw the tax as a necessary means of funding public goods, but warned against the negative effect of the excessive taxation and the bureaucratic inefficiency. Amrita Sen, as we know, is a great novel economics, and as far as about the Amrita Sen views, tax as a critical tool for the promoting social justice and reducing the inequalities. He argued that progressive taxation could help the redistribute wealth and improve the overall well-being of societies. In short of all economic definitions, we can say the tax is necessary for the society. Second, we can say excessive tax also a negative impact on the development of the societies. So taxes shall be collected as the requirement of societies, not for requirement of the government. Excessive tax collection impact negative, and it will be hindered for the development of society. So tax can be divided into two parts. First is direct tax and second is indirect tax. So direct tax we can say the directly collected from the person, that is direct tax, and which is indirectly collected from the person, it is indirect tax. So direct tax means tax on the salary, that is called income tax, corporate taxation, capital gain, capital tax, acquisition tax. These are under the direct tax, and we will cover in the next slide or successive topics. What is the income tax, corporate tax, capital gain, capital tax, acquisition tax? As far as concerned about the indirect tax, it is not directly collected from the consumer or the person. It is based on the consume of the goods and services. It means the person who will consume the goods, he will pay the tax, or he will pay the tax, or if he consume the services, also he will pay the tax. Excise duty is same as the indirect tax. Custom duty levied on the export import, and stamp duty in case of the matter of the property, the stamp duty will be levied. So these are the indirect tax, and the main difference of the direct tax and indirect tax is that the direct tax is collected from the directly, and indirect tax cannot be collected directly. It is based on the consumption of the goods or services. Now, what is the difference between the direct tax and indirect tax? I have difference based on the incidence, burden, viability, administration viability, and penalties. As far as concerned about the incidence, so as I discussed, the direct tax in direct tax incidence is directly on the consumer. It means the persons who earn the income will pay tax directly to the government. But under the indirect tax, it incidence shift from the one person to another person. For example, if I am the supplier, I supply the goods to another person, then another person will pay the tax. So under the indirect tax, one person can shift the burden of the taxation to another person. Second, burden. Direct tax is imposed on the individual organization, and burden of tax cannot be shifted to the other persons. It means same person will be pay the tax who earn the money. As far as concerned about the indirect tax, burden can be shifted from one person to another person due to the shift of the goods and services, or we can say consume of the goods and services. Next is viability of payments. Direct tax are lesser burden than the indirect tax to the people, as directed are based on the income earning ability of the people. So viability means what is the level of burden of the taxation. So we can say direct tax burden is lesser than the indirect tax because it is based on the earning. But indirect tax is based on the commodities services. So this direct tax burden is more than the indirect tax. As far as concerned about the administrative liabilities, administrative liabilities means the collection of the cost of the taxation. So as far as concerned about the direct taxation, the collection of cost is more than the indirect taxation. Penalties is levied on the SSC in case of the direct taxation, and penalty is levied on the supplier in case of the indirect taxation. Evolution of the tax laws since British era. So we this is a basic slide to know about the how many tax laws come into force during the British era and after the British era. So first tax law was introduced in 1860 by the British government. After that, second laws of income tax was come into force in 1886, thereafter 1918, and thereafter 1922. Present time we have income tax law 1961. So this is the basic information about the law of the income tax changing by after the periods. This is a basic slides, and I hope you got information about the basic of taxation. In next slide, we will start the Income Tax Act 1961, and it will start from the basic definition. Thereafter, we'll cover all the topic of the Income Tax Act 1961. Thank you for watching.